I'd like to welcome you all to Black Manta, or BMCP.live. Our next one this month is on staking. So it's a hot topic as DeFi rides the exponential curve. So I'd like to welcome you to a great panel. So how we're going to do it today is we're going to have a quick introduction from Cory, Gray, and Joachim. They're going to tell us a little bit about where they come from and how they came to staking. After that, Marcus is going to introduce himself, but also spend 5 or 7 minutes talking about staking and what they're doing with staking. So a little bit more detail on what it is and what they're doing. And then John is going to introduce himself last. And he's going to explain what he's doing with Manta DAO and how staking fits in there, which is quite a different paradigm in the DAO environment than a traditional finance environment. So that'll be very interesting to listen to again for 5 to 7 minutes. When that's finished, we will then turn into having a panel session. So we want it to be very interactive, and we would like that, we got lots of questions, both from panelists to each other and from the floor. So please feel free to contribute, and I hope that we will have an enjoyable hour. So okay, Cory, away you go.
I'm not sure what that was, but my intro, I like it. A little dramatic, of course. Thanks, Brian. Happy to be here. Cory Pugh with BridgeTower Capital. We've got offices in Boise, Idaho, and Zurich, Switzerland. And we are fairly new to this space. We've been in, I guess, formally for about a year now. My background is really more traditional. I ran a company on the NASDAQ for a number of years, and then been in the private and public sectors of private equity for the last, I guess, 20 plus years. So we got interested in this space really through the blockchain. And the first introduction was really on the enterprise side of the blockchain and how that applied to data and how that applied to companies and businesses and how they can have more secure data operations, reporting, and analytics. And then we really got involved in the digital asset space when we heard about the opportunities with companies like an Algorand or an Avalanche, certainly with IBM and the rest that we were talking to. So about a year ago, we figured out, could we participate in this space, being a private equity firm, being somewhat conservative in nature, and how that would look for us. So as we looked at blockchain and we started to get an understanding of staking, a first question is it safe? And is it something that our shareholders, that the groups we work with are going to be comfortable with? And as I look at staking, it really is no different than investing in a company. And, we look at some of the different protocols that are out there. In particular, we mentioned an Algorand that we've started to work with. We decided to self-host nodes, which, the technology component, having the safety and the security of that process, something that we've been involved in from the tech side for quite some time. When we look at nodes or we look at staking on a specific protocol, we're also looking at who is running that blockchain. So there's a fair amount of diligence that's done as well. So it's not necessarily a nebulous black hole that we're involved in or that we're staking assets against. It's truly, there is an underlying asset against the staking that we're doing on these nodes that we're hosting. So we felt, that it was a conservative, safe opportunity. We do our due diligence and we're very cognizant of who we're working with. So from that standpoint, I think from a traditional private equity point of view, we feel very comfortable with it. In fact, we've had no issues when we understand and individuals understand. We are indeed in doing our due diligence, working with companies that are world-class companies. And the blockchain, really has proliferated in many places, a lot because of some of the regulatory bodies. You look in the US with the SEC and the OCC making statements and allowing banks to participate. And that's really grown it and given a lot of visibility to the space, which is helping. So we're seeing a lot of adoption. And so we're excited to be in the space and look continuing with that.
Thanks. Maybe Gray, over to you.
Cheers, Brian. My name's Webb. I'm one of the co-founders at Liquibit. We're a asset management and technology company, which originally started out in 2018 we were formally put together, but we did, the co-founders have been trading crypto assets on our own books since about 2015. In fact, we were one of the original market makers on BitMEX back in the day. We have since last summer launched our first very traditional looking Cayman hedge fund. And a bit like Cory, we target relatively, say, conservative investors. We're a yield-based product, fully market neutral, 100% arbitrage, US dollars in, US dollars out. Investors not holding crypto. The entire team is 20 years plus each back in traditional investment banking, and mainly equity trading, equity risk management, and IT. So, you know, coming into the investment space with our product and the mandate that our fund has, which is, as I say, market neutral. We're looking at yield, enhanced yield for our investors, and staking actually then gives us something to start to look at. And well, we're relatively new into looking at staking. We've started that about 5 months ago, started doing our due diligence, touching on what Cory said. There's a fair bit of understanding the underlying tech. There's a few staking as a service type products out there. And in fact, some of our custodians even provide access to those. So we're sort of starting out on our journey, and we've started deploying some small amount of capital to staking. And from our point of view, it's absolutely a valid part of a portfolio for our mandate, such that if we're not deploying capital fully on exchanges through arbitrage transactions, then staking offers another alternative to placing capital to earn yield for investors.
Thank you. And over to Yakum then.
Hi, hopefully you can all hear me. I am a partner in a firm called 01 Capital. So we are an advisory firm in the sector. So most of what we do is corporate finance advisory, but we also advise on token economic work. So, you know, we have designed the token economy for some couple of layer 1 blockchains and also layer 2 blockchains. And, you know, staking is something that's absolutely vital in some cases to like the sound functioning and governance of a blockchain. It's obviously very interesting how staking has evolved, you know, from and it has different use cases now. But it's something that we are spending a lot of time on at the moment, and that is extremely topical.
Thanks very much. So I'll hand over to Marcus now, who will spend a few minutes just taking us through the basics and what he's looking at.
Awesome, Brian, thanks a lot. Then let me also quickly share my screen. I hope it's working fine. 1 second, everybody. I'm pushing the play button and hope everybody can see the slides. Otherwise, please scream. And as Cory was already saying, I'm part of BridgeTower Capital here in Switzerland, Zurich, and I'm directly jumping into the slides. If my slides would, no. Now my slides are working. Yeah, you know, we spoke about staking, and the focus of this session today is staking as well. But BridgeTower Capital is not only investing into staking, but also on the broader DeFi play. So, and I'm explaining in a second what DeFi is. But at the end, what we are trying to achieve is growing our assets under management by actively staking, providing the infrastructure, being active in DeFi and yield farming, and trying to provide as highly attractive returns as possible to our investors, and then spinning this flywheel continuously, and then really riding this wave we currently see in the crypto space. But before we're starting, I think we need to step back and have a look what is really the crypto space and what is blockchain. And for us, the crypto space is more or less a layer on top of the current internet. It's really the next evolution step in the internet. it's for everybody of us, it's a little bit hard to understand and to grasp what is really currently going on, because we cannot really understand this exponential growth we currently see in the space. You know, internet was somehow still linear, a couple of websites here and there and Facebook, and this was something everybody was able to understand. But currently we see really this exponential growth with a lot of industries merging together, be it the financial industry, the entertainment industry, gaming, art, you name it, all the industry are currently merging based on this new digital layer. And on top of the internet layer, as said, we have the blockchain layer more or less separated into proof of work. Everybody of us knows Bitcoin. You know, you need a lot of computers in a row running parallel to try to solve this algorithm puzzles and producing new blocks and new Bitcoins. And what we currently see is a lot of newer generation blockchains are migrating or already building on proof of stake, which is a more efficient way to find this consensus algorithm and run a blockchain. And the third layer really on top is the application layer. So we have the whole DeFi universe, the Web 3.0, or however you want to call it, including the security token markets. So this is really layer on top, number 3, where we're also playing the DeFi and the yield farming games. And as I said, you know, to run these blockchains, you need software and hardware. Similar like the internet, you need software, HTTP, and you need hardware. And there's no difference in these blockchain networks on top of the internet. Proof of work and proof of stake are the two most common ways to operate a blockchain at the moment. And going to the next slide, proof of stake compared to proof of work, we simply need 99% less energy. And this is a huge change compared to proof of work. We also have less e-waste. So we, you know, with crypto mining, every 18 months, roundabout, the hardware is outdated. Proof of stake is more resilient, more resistant, as it's highly decentralized. And as stake is more or less indicating, we have capital as a collateral to run this model. And capital always needs there's a unique investment opportunity, which we at BridgeTower Capital are trying to offer and to help our clients with. And in that sense, I'm moving directly to the next slide. Long story short, BridgeTower Capital is also operating these so-called validator nodes. You know, in proof of work, we have the miners. In the proof of stake world, we have the validators. So there's a clear distinction based on the name. And BridgeTower Capital is running in data centers together with several partners, validator nodes for at the moment selected blockchains, including Algorand. We are targeting for sure the larger foundational protocols, but we are also currently working on more new and aspiring protocols like Sentinel and Cosmos SDK-based blockchains. So there's a broad list and a long list of blockchains we are planning to support and be involved with. And at the end, we are running these validator nodes in an institutional grade manner. By running the validator nodes, we're participating in the governance process of these protocols. So we have a seat at the table. And we are also accepting retail public delegations. So it's our goal more or less to grow really the stake, the collateral as much as possible. That said, this is more or less a quick summary. Probably Cory is better at summarizing and showing the roadmap of BridgeTower Capital, but this is a global tokenization play. As blockchain and decentralization is global, BridgeTower and the security token offering is a global play. And we have several partners. We already have partnerships signed and a lot of partnerships are coming. Doesn't need to mention Black Manta, or I should mention it as much as possible at the moment. Much looking forward working with Black Manta here as well. And yeah, team. And in that sense, I'm handing over again to you, Brian.
Thank you very much. So that is a very interesting approach to looking at giving people access to staking. So we finally go to John to introduce himself, who John is the founder of Manta DAO, and we'll have an alternative view of how this might work now.
Sure. Thanks so much for having me, guys. John here from Manta DAO here in Hong Kong. Really excited to be sharing a little bit about kind of our take on how we do staking, how we participate in DeFi, Web 3.0, from probably a totally different angle than a lot of the other panelists on the call today. So just to give some basic background on what Manta DAO is, how we operate, how we participate in these different kind of DeFi Web3 ecosystems. We launched as an ICO project back in August of last year. The whole kind of story was building a staking, lending, and kind of governance-focused platform built on Polkadot, which is obviously a proof of stake network, which potentially some of the other panelists on the call are running nodes for. So essentially our whole model was that we would run a validator business. So we run nodes for any number of different public blockchain networks, proof of stake networks, approximately 16 or 17, I think, maybe even 20. Honestly, there's a lot, I'm not entirely sure. And the whole model is essentially that through the external delegation of individuals, they can come to our platform, delegate to our nodes on our platform, and they can earn an additional interest in our token. So let's say you're making a native token reward in DOT, you would also earn OHM tokens, which is our native token, if you're delegating to our node on our platform for a set amount of time. Obviously, the tricky part about that is DOT is on Polkadot, and currently OHM is on Ethereum and BSC. So how do you match these two networks and track this kind of information and all these different things? So that was one of the first conundrums that we came across. Essentially, that whole model is inflationary in its nature. We're essentially paying people to, delegate to us to a degree, incentivizing them, maybe not paying them. So we obviously have a vesting schedule on these sort of tokens that are the extra bonus. But the other part of it, which is tangible, is that we have a model where we take 50% of those validator rewards or the earnings that we're making, both from our own personal stakes, from the foundation stakes, from the team stakes, and from the external delegations that we're charging commissions on. And we take 50% of those rewards on a weekly basis, and we buy back our tokens and we remove them from circulation. We don't burn them, but we remove them from circulation. And so far, we've removed about a bit over $1 million worth of tokens through this method. So that's 50% of the rewards. 25% gets restaked, and 25% goes into another one of our products, which is also deflationary, called the Manta Pool. Manta Pool is this lottery pool, which literally, it's literally kind of a gambling lottery. People can come in, they can spend their own tokens, they send them into this burn wallet, and they have a chance to win 25% of that week's rewards. So actually the economics on this has been phenomenal. And this has been on Ethereum, where it's expensive to participate. But for every dollar we've spent in rewards, we've received over $4 of OHM tokens removed from circulation. So it's super cost effective for us as a way to have another deflationary element to our token model. So that's one thing that's pretty interesting from the staking side. We have a lending product, which is a Ethereum-based money market, which essentially allows people to enable collateral, supply collateral, in about 50 different tokens. I think we're adding 5 more tonight, so 55 different tokens. And then they can borrow against these assets. They can borrow these assets if they want. And they also have a yield farming element there where they earn some OHM tokens for doing so. That is currently live on Ethereum. We're launching on BSC shortly, and we'll also be launching on probably Hecko, Solana. We're exploring obviously Substrate and Polkadot, but that's a little bit further down the line, and a couple of different others. Polygon, of course, as well. We have a Launchpad product, which is kind of all the rage in crypto right now, basically helping projects raise capital and funds. We're probably one of the earlier ones to launch that, and we've done it so fairly successfully at the moment. We probably average about 3 to 4 launches per week, anywhere ranging from $100,000 raised in about 3 minutes to $500K in 3 minutes. Really quick, people are interested, and the hype is really real. But the thing that we differentiate ourselves with in terms of the Launchpad is that we basically allow people to come to us, and not only do they get a launchpad, but they immediately have staking, they immediately have lending, they have other utility elements to their token. So there's other things for people to do other than just dump. So maybe going back a little bit to the staking side, not only do we run these proof of stake pools or proof of stake nodes, but we also run like DeFi staking. So I consider these two different things. I consider like DeFi staking, where it's essentially locking tokens into smart contracts, whether it's just a naked staking pool where you lock one token, earn another token, liquidity mining pool where you provide liquidity on a DEX like Uniswap or PancakeSwap. You provide those provide the liquidity there, take those LP tokens and stake them on our platform, and then you can earn some more rewards, essentially mining liquidity on those DEXs. And we also have a couple different other kind of contracts that we allow for that. So that's also live on Ethereum. We support about 10 different pools at the moment for different projects. And we also have that on BSC as well. So yeah, that's pretty much how MantraDAO, how we work. We have about, I think, 200 million plus worth of assets delegated to our nodes. And I think TVL is well over the $100 million mark as well. So not too shabby for being around for 8 months. And yeah, we're really excited to kind of share a little bit about our different take on this. And I actually was interested in the slide that Marcus had about some of the different partners that they had for in terms of the node hosting, because we are also getting into the infrastructure as a service business as well. So perhaps there's some elements of collaboration there we can talk about offline.
Very good. Well, thank you very much for everyone for the introductions, and just to get a taste of two different ways of approaching investors when it comes to staking. So maybe with that in mind, I'll go back to Cory just to ask, you're sitting in the US, you're speaking to family offices, asset managers and others. And can you maybe just give us a flavor of why they're being motivated at this stage to look at staking as something for yield? What is driving people to speak to you?
I think part of it is that when people really understand what it is, it's a fairly simple process. It's one of those terms, it's a bit nebulous, and we throw around terminologies as if, it's second nature to us. But when you get outside of this core group, these terms mean you're speaking a whole different language. So I think for a staking standpoint, when you really boil it down, it's pretty basic. You're essentially taking an asset and you're staking it against an opportunity, you're placing it against something that's giving you a return. And as I look at that, as long as we're doing due diligence, Gray talked about it, and John as well, as long as you're understanding who you're working with and where you're going, the markets in the traditional sense that we talk to, the investment banks that we're typically working with, we try to simplify what that process is. Again, if they're comfortable with it. It's a process whereby you certainly have to monitor where the different markets are going, where the different blockchains are going. But we take a pretty steady approach, meaning, this game is going to happen. We're trying to be a little more linear in our approach, a little more stable. So, we get approached quite a bit, and I'm asked all the time, well, if I invest, can I make 500x return in a week? Probably not with us. You might find it somewhere else, but we're going to be a little more conservative in nature. So I think, for me, from a traditional standpoint, running a company in the NASDAQ, dealing with different institutions, they first need an education in blockchain, because the blockchain really is the fundamental part of everything we're talking about, is in essence. So we start off there, and I think, as we spoke about before, the regulatory bodies adopting and opining on the blockchain, it's helping a lot. And then the next step is, okay, well, what makes a blockchain run? I just talked to it. It's simply software and hardware. Now, much more complex, but at its basic element, that's what it is. And then in order to operate, you need some type of a system or nodes whereby everything can be transacted in a compliant way. So for me, it absolutely is a safe play. We are probably much more conservative than a lot of people. We're also a security token. So our play is a little bit different in the sense of, we're in this, not that everybody's not in this for long, but as we look at the opportunities of wealth play. So from a product mix, from a private equity standpoint, point, we feel like if we make good, sound decisions with the right partners, patient throughout the process, ultimately the valuation of our company can exponentially grow. And the interesting part about this is you can do this like this. I mean, we're sitting in different parts of the world. I mean, for us to have gotten on a plane and sat in front of, Brian's front row, it would be quite a trek for a few of us. So, to open up an office in Zurich, Switzerland from Boise, Idaho, it works. Then we go to London, then we go to Singapore, now we're pushing into Japan. Australia, you can really start to play a global opportunity. And that was the second piece, I guess, for me. They got really interesting because before that's very difficult to do. And I think in the digital world, it breaks down geographic barriers to a large extent. And you're now taking a global group and you're bringing them together in one product and one opportunity. So I think that's the other piece that's very attractive to us in this entire space.
Cool. So I'm listening there and I'm thinking of, I'm going to Yakum next, actually, because you're talking about how you monitor the risks and how, the various regulatory bodies are getting involved. And, basically it's based on hardware and software. And I know from talking to Joachim, he looks at these things when he's analyzing how to deploy funds. He's regulated himself in the UK, and he looks at these various risk factors. So maybe, Joachim, I could ask you, without scaring everybody, to just go through a couple of the risk factors that you would consider and analyze when deciding, to allocate funds into something related to staking.
I think it depends really on what type of staking you're looking at. So I think, as we discussed, that really two types of staking. One is layer one staking, which is really, in essence, the distribution of basically network resources to those who participate the most, essentially, which is a completely different type of staking than the staking that you see, for instance, in DeFi. Again, like within DeFi, there are some pretty complex staking models. There's some staking models that have a lot more leverage, than others, and then there's staking models that have a lot of sort of unknown risks. So looking at kind of what those risks are, you've got some unknown smart contract risk. You may, in some cases, have market risk. You may have, again, other types of like hacking risks, some which can be insured against and some that can't. One risk that I think hasn't yet been explored much is systemic risk, within all these staking pools that you see in DeFi, and what is the cross-contamination risk, if you had a major kind of event happen, and how that would affect like different types of staking pools system-wide. And I mean system-wide, like across the DeFi space and across blockchain. So that is very difficult to understand, very difficult to model, and possibly also difficult to protect against. But it's something to think about when you assess the returns of staking versus versus what is basically at the moment the unknown in some cases. And I think so. If you're really sort of early to the staking game, I would absolutely concur with Cory that you shouldn't try to get into something that you don't understand. You should go for the layer one staking, because that is essentially early stage technology risk that you're taking on.
Very good. So so when you're looking at it, the whole kind of picture. But I think the Gray, when he's looking at allocating funds, allocating assets from the fund into staking, you're doing it through third parties, and you have a slightly different due diligence process that you would take, managing the fiduciary duties and all that kind of stuff. Maybe you could just explain a little bit to us about the type of way that you analyze what's good and bad.
Yeah, and we've just sort of started looking at this just in terms of another way to bring yield to the investor. If capital is not deployed in our normal strategy, which is sort of index arbitrage, cash and carry, derivative versus spot type, traditional Delta One trading strategy. And I think from our point of view, third parties, back to Joachim's point, we don't trade much outside, say, the top 8 or 9 coins anyway, with deep liquidity on spot and derivatives. So for us, there's a limited pool as we're looking at staking, and really DOT is the one that's sort of come to the fore in the last 6 months. And I suppose from our point of view, it's softly. Our due diligence has involved talking to our third parties who are providing the staking services, so principally Fireblocks, who are our main custodian, and behind them they use Staked. We've had direct conversations with Staked around how they're set up with their node infrastructure. What happens if Stake disappears? How does that Fireblocks ultimately having custody of our keys for our custodial wallets? How do they then actually step in and act on the chain and pull funds back? So those conversations actually with the third parties are quite easy, because it's very easy to have a relationship with Stake. The guys there are very transparent in terms of the way they've built out their node service. And I'd say we've been very impressed with the way the meetings and sessions that we've had with them, and how they're integrating with Fireblocks. I think the other side of it is when we look at other options for us from a fund point of view, leveraging some of the staking services that, say, exchanges like Kraken have. Slightly different model from an economic standpoint, because they give you more flexible periods with ease of pulling the money out, which from a fund point of view is great, because actually if the basis suddenly appears, I don't want to get locked up for 28 days on dot if I was sort of to do the native staking through a stake type service. Kraken can obviously give you a slightly different user experience. I can pull the money out much quicker, but obviously they're going to be capping the yield to pay for that flexibility. So when we look at it, it's not purely just in terms of the return. It's ultimately has that affect the overall liquidity. We're starting extremely small at the moment, just trying to get comfortable with the technology, because the different service providers are offering a slightly different experience. But I think it's one of those things that is a different models, and I'm sure John touched on it in terms of ways to approach staking. There's lots of people coming at it different ways. We're excited to be looking at this as one option, a way of maintaining our returns to the investor at the level that we're looking to give them. And we're going to continue to keep looking. And I think, obviously with Ethereum moving to proof of stake at some point, that's sort of the big headline. That will be something that I think most, certainly for a fund like ours, where we're just trading in really the large cap type coins that has the larger cap to take on these kind of models, then we'll keep an eye on it. But for us, it's service providers are good. You need to be transparent. You need to be able to get on the phone and explain it both at business and a tech level, and understand that from an investment management point of view, it's not all just about the return. It's also about the liquidity and the lockup periods as well.
Exactly. So you're taking it on. You're looking at getting access to that yield, but you're all the time maintaining that flexibility, because if a trade comes up, you need to get there. Whereas, Marcus, you're looking at it from sort of a longer term perspective, like private equity type perspective. So you're down looking at validator nodes and things like this. You had on the slide a number of protocols that you're working with, and also others that you're selecting. So what sort of process do you go through when looking at a selection of the next node or the next batch of protocols that you're going to be working with?
Very good question, but I would like to comment quickly on this lockup period we talked about.
Absolutely.
I think what we currently see is we see derivatives coming to staking. So it's kind of liquid staking, and at the end the locked token will be tokenized again. So it's like a token in a token kind of concept. And I think, although we saw it with a couple of exchanges already, which are offering that now, and we mentioned some of them. I think this market will become of significant size, to put it frankly, and that will be interesting to participate in, and on the different layers, right? Really operating these validator nodes with service partners and other partners, having our stake deployed, and then offering these tokenized staking tokens again. I think
are you doing that already?
Yes and no. We are currently talking to some people which are planning to do it on the Cosmos SDK.
Talk to us too.
Will do. I think this will be super exciting, right? Everybody, including myself, if I'm doing it on a private base, having this 3 weeks lockup period might be sometimes a pain, and yet I want to have the rewards. So, this is the thing I was mentioning at the beginning, this exponential growth. There's a problem, and more or less within months, the industry is currently developing solutions, and these solutions are developing a new market.
Maybe now is the time to talk about NFTs and sharded NFTs.
Yeah, exactly.
So maybe we take that diversion now. I know in the
I actually have something to potentially add to what Marcus and Gray were saying, I guess. So we are also going to be doing liquid staking on a layer 1 level with proof of stake validator nodes and their assets. But we're already pretty much doing that with some of the Ethereum staking pools that we run in BSC. This is pretty interesting, particularly because we also have lending products that enable you to use your staked assets as collateral. So imagine if you're able to be earning your 10 to 20% staked asset you have, you take a derivative token of that, you enable it as collateral, because you can't obviously remove it from the staked node, but then you can then borrow against that and do other different things. Obviously, this is leverage on leverage to a degree, but it is a very interesting thing, and it's a very crypto idea of of kind of levering up to continuing to access yield plays. So this is a pretty cool thing that I think is coming more and more, particularly as you see more kind of interoperable technologies be created. Thorchain, I think, and Rune is doing something really, really cool with this. Obviously Cosmos with the IBCs coming out, that's going to be really interesting. And then of course Polkadot and Kusama are the blockchain of blockchains. So all of these technologies are promising this to be happening in the near future. There's some people who are going to be taking the forefront on this, and it's definitely exciting to watch. And I agree with Marcus. I mean, this can be huge. And then there's one other slight little thing to add that is an interesting thing, not for proof of stake nodes, but for more DeFi staking pools. So a lot of our pools also have lockups, and obviously we have lockups in order to prevent dumping of tokens. But one of the things that we also do is we have an immediate unstaking fee if someone really wants to get out, and obviously that unstaking fee should be painful enough that if you come out in and out too quick, you're going to be losing money unless the token appreciates in value. And we actually do this for all of our pools pretty much. And you'd be surprised. We have it a very low fee. So it's 2% of your unstaking amount. And people do it all the time. And this has actually become one of the bigger revenue generators for our staking pools, because we don't actually charge commissions on these Ethereum DeFi pools. We're not making money from that. But the way that we make money now is basically a slight integration fee, which we take in the company's tokens. So we say, okay, pay us 10K per pool in your token. We'll stake them. We'll participate in this. We're not going to dump it. We don't really need the cash, but we do want to participate. And you have to have an unstaking fee for your community to get out in and out if they want quickly. And they do it all the time. And we collect that fee in their token. So it's a pretty interesting model that, particularly for retail, I think is attractive, because obviously they want to be able to trade. They want to be able to move out in case they don't like, the way that the market's moving. So it just gives that kind of flexibility, but it also makes us money.
Cool. So maybe going back to the sharded NFTs, and Joachim, I'll hand over to you for that fun.
Yeah. So a lot of fun things are happening in the NFT space, obviously, and amongst them is NFT staking, effectively. So I'm sure you've seen both on Ethereum, but I guess right now a lot of things are happening on Wax with NFT staking. Basically, you can take NFTs from different games and platforms and stake them, in pools and get a lot of it. It's a very interesting cross-pollination between different games and different NFT collections. And in some cases, you can sort of generate tokens through the staking that can then be used as fuel to create new NFTs. So it's really evolving in directions that, you know, I don't think anyone would have sort of foreseen 6 months ago, and very, very exciting. I'm certainly very active in that space myself.
Okay, so I won't ask you about tax because that's just far too much fun.
It gets far too complicated, and I think I think that there's a meme out there with someone basically using crypto to buy sort of a pet Tamagotchi that he's then restaking somewhere to earn more crypto. And yeah, it's going to be a very, very, very interesting season for the taxman to sort of drill into all these things and get their heads around it.
So speaking of getting heads around things, John, you run a DAO, so that's a slightly different form of organization. How is it that a DAO looks at, you know, putting assets on? You know, if you're a Gray, you're a fund manager, and there's a, you know, everyone kind of understands what a fund manager is doing, but how does a DAO select what it's going to be doing next and select the assets available?
Yeah, I mean, it's a tricky question, and obviously when, you know, we have a utility token that's meant to be a governance token for deciding all different types of various parameters within our system, that can become a democratic mess. You have people who just don't know what's happening in the system, and they propose all kinds of crazy things that would definitely harm the system. So it is a fine line, right? And, you know, particularly as an early stage project, you know, releasing full governance capabilities to, you know, essentially the retail public is dangerous. You know, if you think back to YAMS, which is back last summer, which was one of the first DeFi protocols that really, you know, went through the roof before all these food coins came out. There was basically an economic or even a logical flaw in how their governance worked, that if they didn't reach quorum, they could never make the decision to change anything in the system. So it ended up that YAMS actually just exploded and went essentially to zero. So obviously we don't want that to happen. And we have to be careful about what types of decisions we allow, what types of decisions are hard, what we call hard governance, what types of decisions are soft governance. So the way that we do it a lot now, currently in our kind of early stage of the development of the DAO, is a lot of the decisions are done on something called snapshot.page. Snapshot's a really cool protocol that allows for gasless voting, and people can issue proposals based on whatever strategy that you want. And actually, the way that we do it is that, or that we had to, we're going to actually have to change this because we've added too many different products and have our token staked in all the types of different things. But originally, it was meant to be one Ohm token staked equals like the equivalent of one vote. Now we have like 10 different pools on a bunch of different chains, and we have a money markets and all these different things. So it's a bit convoluted at the moment. But originally, that was the idea, and you had people basically issuing proposals to do all kinds of stuff, whether it was add a new asset to the nodes, whether it was reduce, you know, the collateral factor of, you know, whatever token on our money market, whether it was to, you know, give more rewards, whether it was to change the name of the company. I mean, there was all kinds of stuff. You know, obviously some of them are a bit more pertinent to the operations and business running than others. So obviously, you know, we want to be community focused. You know, when you're a token project like we are, the token is a product. And, you know, the community is the first group of people that you got to take care of, end of the day. And that means listening to them. That means taking their feedback into consideration. And, you know, to be honest, we've had some really great success stories on, you know, community contributions, which have led to not only great financial gains, but really wonderful partnerships. So there's one particular one that I can think of where, you know, we're really early on. We had a very early supporter who was able to introduce us to Sandeep from Matic, now known as Polygon. And we made a decently sizable investment into Polygon. I was just checking my phone just a second ago to see what the price was. We made a decently sized investment into Matic when it was right around 1 cent. It's currently about 90. So that's done super, super well. We're also one of the Genesis validator nodes for this network, which is an Ethereum layer 2. And we are all, which has then become, you know, I think we're probably top 3 nodes on the entire network in terms of the total size staked. which was an opportunity for us. So, we have about $60 million worth, approximately maybe $70 million worth of Matic on our just one node, which is really crazy. And that was from a community member, so I think from a DAO perspective, it's important to, listen to your constituents. Obviously, I have not been voted into power, but, essentially I could be removed. So I hope, knock on wood, that doesn't happen. Yeah, I mean, these types of things are really important when you have a, all these different types of products that are complex, and, for lack of a better word, they just don't understand a lot of the time.
Agreed. So DAOs and MAOs are a fascination that we could have a whole hour session, many hour session.
Probably. Probably.
As well.
Right. Maybe real quickly, a comment on Polygon. And, we talk now about non-fungible tokens. We talked about staking. And I think one great example about, I also said all the industries are currently merging, entertainment, gaming, and so on. And we have this Avagotchi game on Polygon. At the end, you have, based on the Aave money market, you have the staking tokens, be it whatever, AAVE or USDC, even stable coins. You deploy them and kind of stake them in this DeFi pools or this DeFi way, and you can deploy it to this non-fungible tokens, these Avagotchis, which are nothing else like a visual representation of these underlying tokens, the underlying. And this visual representation itself is kind of a game. So it's really great to observe, and everything is running on Polygon. It's really great to observe that we see games and real high interactive kind of applications running on the blockchain, having real assets, not real assets, but kind of stable coins as the underlying, and we have this complete stack of different tokens, non-fungible token, fungible tokens, staked elements in it, and this is really great to observe.
So as predicted a long time ago, we have about 2 more hours of conversation to fit into that. But before I get to Anthony's question, which is coming from our participants, which I'll probably direct at Gray and Cory, I'd just like to ask Yakum, we're talking about here the design of tokens and how they're designed when it comes to their stakeability, if you want to call it that. That is something you consult on and something you work with. So I know you have some strong opinions on what's good and what's really bad. So maybe in a couple of minutes, you could just give us some thoughts about the tokenomics of some of these staking models.
Yes, certainly. So I think, the tokenomics can actually be subdivided also into 2 parts. You often have the case of, token being launched with a use case that's really 6 months out, or maybe a year out, because it takes time for networks to develop. It takes time for use cases to really be fully developed as well. And, that part of a token economy can have, a staking element, like a fundamental staking element. But what you often see now is that people or projects will overlay, also interim staking models that happen between token launch and the actual quote unquote like mainnet, or the kind of the proper deployment of network. And those token models, I think are very, very important, because effectively every token launched today competes against other tokens largely on the basis of the strength of the staking model. I think that's something I'm sure that Manta DAO sees a lot of at the moment. I think with that there's, that's great, because obviously it engages the community, it creates like an interim use case for tokens and so on. But there's also a little bit of a pitfall there where, we've started to see some of these like very aggressive staking models literally kind of stumble and kind of, collapse basically due to like yields that are too high. So basically what happens is like, the yields initial are so high that there's no way for the project to actually properly catch up with the expectations then that are set by these very, very aggressive staking models. So, what's really important is to think carefully about like how you calibrate these, whether it is, stake liquidity incentives or like incentive models around like just locking up tokens. You need to be careful to make sure that it's not too little, but also make sure it's like not too aggressive a model that really creates like the wrong dynamics around the community.
Thanks very much. Maybe we'll just then rush quickly to Anthony's question. And I'd like to direct it towards Cory and Gray. It's Anthony's saying that he co-founded a collaborative investment platform for wealth manager. He'd like to add additional services about crypto. And have the panelists thought already about a solution for delivering staking to wealth management and the wealth management industry? And obviously, you two both interface with the wealth management industry. So I'll hand over to you.
You go, Cory.
All right. Yeah, absolutely. I think that's a target for us. I mean, the institutions, the funds, the investment banks. Again, I mean, being a little repetitive, he said it very well. It's expectations too. We had a call last night, and it's an individual group I've spoken to 4 times now. And I don't know how many times I can say it. They want these returns that are so exponentially large that you have to set those up front and say, look, that's not really our play. So I think number one is setting expectations, being wise about what you're communicating. You're communicating in a very clear way. And if you're going to be a fund, if you're going to be an investment bank, our company's a security. When you invest in us, you have to be an accredited investor. So we have a level of scrutiny that's on top of us. It's extremely important to us. So transparency in what we're doing is vital. So, whether it's a fund or it's a wealth, we've had all kinds of different groups of just. But it all comes down to, again, to me anyway, in the space we're in, is the regulatory bodies paying attention very, very closely to what's happening because it's moving fast. And that's, I think, a challenge for us is understanding and making sure, when we're playing in multiple jurisdictions across the globe, which are regulated in much different ways. So there's one piece you got to pay attention to. Secondly, and we spoke to it, tax. How's that going to come into play? What's going to happen? We've run into several groups that 2-3 years ago got caught up in some ICOs and SaaS, and I think there were some really good companies trying to do some good things. And there was a lot of other ones that were just trying to make a buck and a quick buck. And so there's some scar tissue here that we have to be very cognizant of. So yeah, I would say there is definitely space, and highly encourage the more traditional groups, funds, investment banks, whatever it be, get involved, get educated, and work in a level of, go slow. We've been messing around for 12 months in this space, frankly, and it's taken us 12 months to kind of navigate, figure out who's who, and it's been a good process. And Ray spoke about it early. I've been very impressed, new to this market, the partnerships and the collaboration that exists. If you're willing to be transparent and open up and talk to people, there is a lot of wealth of knowledge and individuals, companies doing things the right way. And, for us, it was worth jumping out of some pretty large PE holdings to get into this space. And, but yeah, I'd go for it. Long story short.
I'll double down on what Cory said in terms of transparency and the quality of collaboration generally in this space. It's fantastic. It's extremely refreshing. It's one of the things that ultimately I think attracts talent from other areas of, say, more traditional finance. That's certainly one of the things that I think is common amongst most of the projects, the founders and the investors that you talk to, because people are open-minded, and no one's figured all this out. And back directly to the question from the audience, I think, from my point of view, we product its mandate, and then obviously have the hedging capabilities that we have our activities. to give investors those yield-like returns. Times.
And very quickly, maybe just ask John, who runs an alternative kind of structure. Do you see many institutional or professional institutional investors or regulated investors coming and interacting with you, or is that something too new for them?
I would love if they did. So far, we're probably a bit more retail, to be honest. I mean, we're from all the gentlemen on this call, we're probably the most radical in terms of our staking systems. But I would say our level of infrastructure, expertise, understanding is as professional and institutional as it comes. So, we operate like we're a top tier validator. And we've done this within, a very short period of time. So we like to consider ourselves up there on par with a Staked or a Floorball or, a Cosmos Station or some of these other big guys, who do great stuff. We've just taken a different way of doing it. And I think one of the things that we've also used successfully is, going after some of these up and coming networks. So two that ring a bell for me would be obviously Polygon, which has been huge. And another one that I think has a ton of potential is Cardia Chain, which is also, we got in very, 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 very early. And have become one of the Genesis validators, which obviously receives a lot of stake, from the community as one of the first. We were a bit too late to hop on like Atom and some of these other big guys, Tezos, Algo, to really make a dent too much, just because it's so out of reach. Some of these other ones have massive stakes, massive delegations. So our strategy is to kind of again play the radical one and go a little bit less off the beaten path. But that does not mean that we would not welcome working with, any regulated or institutional investor to come delegate to our nodes. Again, we are as transparent as we can be when it comes to our business practices, how we operate. And, this is an open invitation to anyone who wants to talk to us about anything, whether it's a fund manager, whether it's just a general investor. Happy to share, our infrastructure, our business, how we operate it with anyone. So that's my shameless plug for the evening.
Well, maybe we can finish off by very quickly just answering Alan's question, and I can start because I'm a customer of yours, John. So Manta is obviously a staking protocol, but if anyone has an opinion to share, we can maybe just share that and then wrap up. So you can see Alan's question there. What are some of your favorite staking protocols? Yeah. So anyone care to hazard a suggestion? No?
Okay. No? I know I use a bunch of other ones. I mean, I like Auto Farm, which is a pretty cool one on BSC. They have a bunch of different vaults that are pretty awesome. Who else do we use a lot? I mean, this is not only like staking protocols, but just kind of liquidity provision. I do a lot on Polygon, so QuickSwap. Been farming and mining Quick a lot, which has also been doing really well. Define's coming up, DFYN. What's it called? Bunny, Pancake Bunny or whatever it's called. Another BSC one. These have crazy names. They're also pretty good. Some of the other good ones in just terms of validated providers. I mentioned Stake, Floorball, Citadel One's good. They're solid.
Okay, I think we're over time, so that's a long list.
Good. We're like agnostic, right? We want to be in everything and work with everyone. So, we're chain agnostic. We are partner agnostic. We are, protocol agnostic, provider agnostic across the board. If you're good, provide good service, we'll work with you. And I will use your platform.
Okay, thanks very much. We're gone over time. Thank you to all of our panelists. We could, as I say, keep talking for hours on this, but we have to call it a day. And I'd like to thank all of our audience for turning up. And We'll see you again next month for the next BMCP Live, which is about a less esoteric thing called property. It's caused more blowups than crypto ever will, and probably will continue to do so, but people think they know it. We'll talk about it next time. Thank you.
Cheers.
Cheers, folks.
Cheers, guys.
Thanks, guys. Appreciate it.
Bye-bye.